The central banks are buying for other reasons. They're not buying gold because they think, wow, it's a good investment right now.
Right.
Interest rates might come down. They're buying gold for other reasons, so they're price agnostic. So that's why I think the main reason that Western investors, large and small, have not really moved into gold. And that's even exaggerated when you look at the gold stocks.
Right.
Because, if interest rates are high and the dollar's strong and the stock market is strong, you don't buy gold stocks.
Gold prices have surged to $2,365 per ounce, reaching a notable two-week peak in early European trading on Thursday. This increase is primarily driven by the anticipation of interest rate cuts by key global central banks, which are intended to bolster economic growth. AdrianDay of AdrianDay Asset Management acknowledges the possibility of short-term corrections or pullbacks, but maintains a positive outlook on the overall trend. A significant factor in this scenario is the large number of individuals and institutions in North America and Europe that currently need to invest in gold, indicating substantial untapped buying power. On Wednesday, gold's price advanced after reversing Tuesday's decline, which followed the release of mixed U.S. economic data. This data suggested the potential for lower borrowing costs the U.S. Federal Reserve set. Consequently, U.S. Treasury yields dropped, and the Greenback rose, which failed to curb the rise in gold prices. Day points out that despite the relatively strong dollar, high interest rates, and healthy economy, there may be better times for Western investors to buy gold. Nevertheless, central banks continue to purchase gold for reasons unrelated to its investment potential. UBS has revised its gold price forecast, projecting it to reach $2,500 per ounce by the end of September, up from a previous estimate of $2,400 per ounce. The Global Investment Bank also anticipates that gold prices will continue to rise, reaching $2,600 per ounce by the end of 2024 and $2,700 per ounce by the end of June 2025. Day further suggests that the Federal Reserve might shift its approach by monetizing debt, which would be highly inflationary. This strategy might become necessary if raising interest rates fails to attract sufficient buyers for government debt, as easing the economy would be challenging without such intervention. Join us as we delve into AdrianDay's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Markets, well, as JP Morgan famously said when he was asked, what do you think the outlook for the stock market is? He said it's going to fluctuate. I mean, there's no question in my mind that we've definitely got very, very strong forces that are driving gold upwards. And that trend is upwards. Whether we get a correction or a pullback at some point, that's a different issue. But
Right.
the trend is definitely in the right direction. And the really powerful thing to me is not so much who is buying gold, but who is not buying gold.
Right.
That is virtually every individual and institution and mutual fund in North America and in Europe is not buying. That means that there is just tremendous, shall we say, buying power on the sidelines. I think it's reasonably simple. I mean, if you take a snapshot of where we are today, you look at a reasonably strong dollar, come off a little bit in the last couple of months, but a reasonably strong dollar, you see reasonably high interest rates and interest rates that have moved up aggressively. You see a Federal Reserve and a European Central Bank that don't appear to be in a hurry to cut rates.
Right.
And you see an economy that is still on the surface doing well, and you see a stock market that is still moving up. Well, that is a scenario, frankly, where you sell gold. You certainly don't buy gold in that scenario.
Right.
And so for investors, this doesn't appear to be a great time to buy gold. I mean, I'll argue with that, but and as we've discussed before, and as everyone knows, the central banks are buying for other reasons. They're not buying gold because they think, wow, it's a good investment right now.
Right.
Interest rates might come down. They're buying gold for other reasons, so they're price agnostic. So that's why I think the main reason that Western investors, large and small, have not really moved into gold, and that's even exaggerated when you look at the gold stocks.
Right.
Because, if interest rates are high and the dollar's strong and the stock market is strong, You don't buy gold stocks. I don't know why anyone will buy a 30-year US government bond paying, what is it now, 4.5%?
Yeah.
When inflation is, CPI is at 3.5 or something, but
And that's these numbers. You know, if they go back to the 80s and 90s, how the way they calculated, it's like 7%, 6% or more.
So people are just going to begin to demand, with fewer buyers, people are going to demand higher yields. They've already had several auctions, auctions of treasuries in the last couple of months that have been very, very weak. And the 7-year treasury auction, 10 days ago, was excessively weak. And the dealers were left holding a lot of the bonds. Well, that means people are just going to demand, they're going to have to pay more to get people to buy. The other alternative, of course, is that the Fed changes direction. They don't have to lower rates, but they start to monetize the debt. And I think that is a high probability. And that, of course, will be very inflationary, as we've experienced before. But I mean, that's the only answer. If people are not buying a debt and you have to raise rates to get people to buy, but you're trying to lower rates to ease the economy.
The unemployment rate is forecast to remain unchanged at 3.9%, with annual wage increases also holding steady at 3.9%. According to ADP, wage growth for job changers has moderated for the second consecutive month to 7.8% year over year, while pay increases for those staying in their current jobs remained unchanged for the third straight month at 5%. AdrianDay notes that a meaningful rise in the unemployment rate could influence the Federal Reserve's decisions. Federal Reserve Chair Jerome Powell has indicated that a minor increase in unemployment would not suffice. A substantial and steady rise is required to sway the Fed. Recent economic data releases have bolstered the case for imminent Federal Reserve rate cuts, which would exert downward pressure on U.S. Treasury bond yields and benefit gold. The U.S. 10-year Treasury yield has dipped to a 2-month low, fueling speculation about disappointing forthcoming job data. The markets are now pricing in a greater likelihood of an imminent rate cut by the Federal Reserve amid signs of a slowdown in the U.S. economy. AdrianDay highlights the Fed's dilemma. To effectively combat inflation, raising interest rates might be necessary. Despite the core PCE inflation numbers indicating some control, real inflation might still be higher. Let's get back to the interview.
I don't think Jerome Powell and the Fed is going to change direction because of the stock market. I mean, other than a 1929 collapse.
Right.
And I don't think they care too much about AI if NVIDIA falls 30%. I don't think that does it. What will do it is one of two things, in my view. Either meaningfully higher unemployment.
Yeah.
And I mean, as we've discussed, I think the unemployment rate number in the US grossly understates the real pain in the employment picture, with people having 2 jobs, with people having, part-time work instead of full-time work, and driving Ubers instead of, working in an office in white-collar work. But it understates the difficulties in the employment market. But nonetheless, I think a significant move up in the unemployment rate will get the Fed, will certainly tilt the balance.
Right.
Now, Jerome Powell himself said last month, he said, I'm not talking about 1/10 or 2/10%. So we're talking about a steady, meaningful increase. But I don't think even that alone, that will tilt the balance. The other thing, of course, will be institutions failing. Another central bank, regional bank failure. And that looks as though it's getting closer, doesn't it?
It does, yeah.
Banks are beginning to write down some of their loans, and other banks, even more importantly, significantly, not writing down loans, but they're not getting paid on. So it's just pretend and extend. So that, I think, will cause the Fed to change direction. But, as we've discussed, and as everybody knows, the Fed really has a dilemma here.
Right.
Because they should increase rates to kill inflation. I mean, even with the PCI numbers or the core PCI, let's make it as narrow as we possibly can. The core PCE that came out, okay, so it was 2% month on month. That's still 2.8% year on year. And even if you extrapolate to 2% going forward, that's 2.4, that's still 20% above their own arbitrary artificial target.
Yeah.
But nonetheless, they look at that, and but I think a lot of people see that inflation is actually higher than that, and so you need to raise rates. Bill Dudley, the former New York Fed president, made the point this morning. You need to raise rates in order to kill inflation, but they know full well that that will hurt the economy, particularly the lower 50% in terms of income and assets. And I think more importantly, that will potentially cause disruption in the things we're talking about, commercial real estate, regional banks, but also just make the US federal government's problem in financing debt much more difficult. Because, even if rates stay where they are, the amount of money that goes on servicing the US debt, we're talking about the US here, but services US debt is going to increase, even if rates just stay where they are. Because the 5-year notes that they issued 4.5 years ago were issued at under 2%. When they come due, but US government is not paying off any of its debt. I mean, I hope everybody realizes that.
With the steady unemployment rate and wage growth, how significant do you believe upcoming job data will influence the Fed's decisions? What economic indicators do you monitor most closely? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.